Thanks for staying with us on Point. The World Bank has approved a loan of $750 million to South Africa. National Treasury says the aim of the loan is to help protect the poor from the effects of COVID-19 and to support economic recovery from the pandemic. The department says the loan will support the implementation of the Economic Reconstruction and Recovery Plan, as well as help put the economy on a more resilient and inclusive growth path. Director General at the Treasury, Dondo Mogojane, says the funds will assist in addressing the immediate challenge of financing health and social safety net programs. He says the funding is a low-interest loan that contributes to the government's fiscal relief package while reinforcing the country's decision on how best to provide relief to the economy and those worst affected by the pandemic. One economist says South Africa still needs to cut down on spending.
The state's finances in South Africa is really in dire straits, and that's part of the reason why they've decided to borrow this money. We need to get money somewhere because the state is simply spending too much. And I do know this money is intended to be used for COVID reasons, but the reality also is that once money falls into a big pot, it can be used for anything else, basically. We are also running the risk that South Africa's currency, the rand, may depreciate until the loan needs to be repaid, and that may result in a significant foreign exchange loss for South Africa. Fortunately for us, our total outstanding foreign loans are not really that much, so it's not something to be too concerned about. But the bottom line remains that the state in South Africa is simply spending too much money, and they need to cut back on state spending.
Right, let's take a look at the year ahead and what could happen. Nedbank says it expects 2% growth this year. They are adjusting their growth expectation lower for the year, down from 2.4%. Reezwana Sumad, who's an economic research analyst at Nedbank, joins me now. Very good afternoon to you, Reezwana. Thanks so much for your time on SABC News. Talk to us about your economic outlook and what informed that.
Yeah, we are expecting growth, as you pointed out, at 2% this year, down from about 5% last year in our view. We've had to revise our growth expectations slightly lower because of the stage 3 and stage 4 load shedding, the more severe load shedding that we've had in the last quarter of last year. We think that the economy seems to have adjusted to a baseline load shedding of stage 1 and stage 2, and when it gets more severe, that's when it will impede on GDP growth. That being said, a 2% growth rate is close to our long-term potential, still quite low and still not enough to really create employment gains in the economy, but it is still slightly above what the SAB and what National Treasury are expecting for this year.
Mm-hmm. And on the medium term, what are you seeing or what are you thinking?
Yeah, in terms of our medium-term growth expectation, that remains between 1.9 and 2% over the next 2 to 3 years. There are some slight downside risks still emanating from the electricity constraints, still emanating from further uncertain waves, COVID waves that we might have, and the related restrictions that might go with that. Along with the lower commodity prices from the surge that we had last year, which might impact our net exports slightly lower. So there are some downside risks that we are keeping an eye on from a growth perspective. But for now, we think 2%, which is at a potential, seems to be quite likely for this year and for the medium term.
Mm-hmm. Worryingly, you're positing that GDP may recover, but not employment.
Yeah, we have seen quite substantial job losses during the COVID pandemic. We've lost more than 2.1 million jobs. Employment is down more than 13% since the fourth quarter of 2019. And to be able to move back to employment levels, back to pre-COVID levels, we think will take between 3 to 5 years. We are expecting employment growth at 2% per annum, but we don't think that this is enough to claw back those job losses that had taken place in the past 2 years, because the economy's absorptive capacity is quite low at 37% currently.
All right, there's a lot of concern about inflation here and abroad. As Nedbank, you expect 4.4% inflation in 2022 and 5.0% in 2023. Why?
For this year, we are expecting 4.4% inflation rate off a high base from last year, but there's still upside risk to our inflation estimate. And inflation this year, we think, will be driven predominantly by transport, by administrative costs, and by food inflation. Electricity being a key there, keeping CPI elevated. A risk to our inflation outlook is that commodity prices, particularly oil price, we've seen the oil price rally quite sharply since the start of this year and essentially over the past year as well. If oil prices remain above $85 a barrel for an extended period of time, this will threaten to raise inflation a few basis points higher, so above the 4.5% that the SABC is projecting. In terms of next year, yeah.
What are you expecting the rand performance to be like going forward?
Yeah, South Africa is a small, open, a net importer economy. The rand over the last few years has been on a general weakening trend. In the past 2 years, we've seen our trade balance flip into a surplus, and that has been quite supportive of the rand. For this year, we are expecting the rand to return to a weakening bias against the dollar. We are projecting the rand at 16 rand against the dollar towards year end, as our current account and trade balance is turning to a deficit once again towards year end, but also as the Fed becomes in the US